know that Isaac Newton was one of the smartest people that ever lived. But there is a difference between smart physicist and smart investor. Did you know that Sir Isaac Newton too lost his money in the stock market? Yes, he was a great mathematician, great physicist, author, astrologer, etc. But he too made mistakes and lost his money in the stock market. Many times while observing the market actions, you might have seen that some common stocks have gone up and market indexes are trading high. You might as well have heard market analysts say the market is bullish, Sensex grew 500 points today, Nifty has given great returns this year, etc. But when you look at your own portfolio, you might question yourself, or you might say to yourself that, why am I the only one to be losing money? Well, don't worry. Probably you're not the only one to be losing money in stock market. Hi, I'm Namita. Welcome to IndianMoney.com, and in today's video, we are going to look at the reasons why most investors lose money in stock market. Before that, let me tell you a fact. About 1.2 crore people are active investors in India. And to tell you another fact, about 90% of these investors lose money in stock market. Yes, a whopping 90% of investors, both the beginners as well as seasoned investors. Even as the number of investors are rising and are better than the previous data, investing in stock market seems like is a stigma. It remains a stigma for many investors. During this stock market collapse in early 2020, most of the investors witnessed what impatience can lead to, as many of them started liquidating their portfolios. But the market bounced back quickly and even hit or it broke the previous highs after the collapse. Hence, it rewarded many of the investors who remained invested, who were very patient and were well planned. So now let's look at what are the reasons why 90% of the investors lose money in stock market. The first one is lack of investment goals. Now, one of the most common mistakes that investors do while investing in stock market is lack of proper investment goals. You need to articulate and you need to deploy the best tools that will help you or to achieve those goals. Now, these goals can be anything. It could be saving for wedding, saving for child's education or foreign education, saving for retirement, or just saving for your future. It could be anything. But the important thing here is to plan accordingly, to have investment objectives, goals, etc. The second one is not understanding investment. One of the world's most successful investor, Warren Buffett, cautious against investing in companies whose business models you don't understand. This can be avoided by investing in diversified portfolios to ETFs, which is exchange traded funds or mutual funds. Now it is advisable that you remain consistent with your SIPs if you're investing. In case you have not started investing, then it's advisable that it's important that you start with SIPs and simultaneously invest in stocks. Now if you're looking or if you're investing in one particular or one individual stocks, it's very important that you have a thorough understanding of the company's shares before you buy the stocks. The next one is lack of patience. Slow and steady always wins the race. I'm sure you might have heard of this. A slow and steady approach to portfolio growth will definitely give you greater returns over a period of time. Expecting a portfolio to do something that it is not designed to do is basically a recipe of disaster. Now, this basically means that you need to keep your expectations very realistic with regard to the timeline of portfolio growth and returns. The next one is sudden overexposure to market. Now, this is something which is very common in stock market. Now, there is this one person X. He sees that one of his friends has accumulated a lot of wealth by investing in stock market. The very next day, he sees that his neighbor has accumulated wealth or he's doubled his money by investing in stock market. And then he thinks he's suddenly just interested in stock market. And then he thinks that if his neighbor can accumulate or he can double his money by investing in stock market, then why can't he? Hence, he decides that he will enter the market with a lot of money, the amount that he's been saving his entire life with his hard work. He'll invest in stock market. And this is where the person fails. Now, the point here is that you can enter the stock market whenever you want because it's an open market. However, when you enter the stock market, you need to be little prepared. If you're not prepared and you enter the market, it's being very stupid. It's just like you're going deep down the water without knowing how to swim. Thus, when you enter the market, it's very important that you understand how the market functions. You need to develop those skills. You need to understand, or you need to learn the art of investing and then enter the market when you're a little bit prepared. And then start by investing a little bit of money. The next one is, don't just pick stocks. Asset allocation is equally important. Several research studies show that asset allocation is a key of successful investment portfolio. However, investors do this common mistake of choosing or focusing only on picking a particular stock rather than creating or doing a proper asset allocation. So it's important that you, instead of going for a particular stock, focusing on next best stock, you need to create correct asset allocation. The next one is not investing in fundamentally sound business. Fundamentally sound stocks have a transparent and robust business model and professionally well managed as well. Such companies can survive any of the economic downturns and are probably the first to recover and outperform as in how the economy recovers. You might remember the year 2008 that witnessed one of the worst corrections in the history of stock markets. Many investors were panicked and they sold their investments for heavy losses as if there was no tomorrow. However, those who remained invested received immense benefits as the market recovered quickly within the span of 24 months. Similar thing happened post the severe corrections in March 2020 when the market abruptly crashed post as in how the COVID-19 pandemic emerged. Many investors again sold their investments. But, however, the market quickly recovered and those investors who stayed invested again received immense benefits as it recovered within the span of 11 months. Therefore, whenever you invest in stock market, it's important to understand that whenever you invest, you choose the stocks of fundamentally sound. The next one is relying on emotions. There are several biases at play when you make an investment decision. Emotional decisions in a volatile market is another investment mistake that many investors end up making. If you cannot decide if you to buy or to sell a particular stock in the next few days, then you're probably making an emotional decision. You cannot rush with your investment decisions because you felt like it. The lesser feelings are involved in your investments, the better returns or the greater returns you will get over a period of time. The last one is holding on to the losers. Yes, you should not sell the stock if the price of that stock is going down. Rather, you should hold on to it if you are confident that that particular stock will give you greater returns over a long period of time. On the other hand, if you see that stock is giving you bad results consistently, then only you should take out your money and invest in some good stocks. So you should not be quick at making decisions which one to buy, which one to sell. Take some time and study the market, study how it functions, study its previous data and then only make a decision. So these were some common mistakes that most of the investors make and 90% of the investors lose their money in stock market. Therefore, avoid these mistakes and there are many more mistakes that as in how you invest in stock market, you would learn yourself. For more such financial content and content related to finance, business, agriculture, career building, etc., download our Financial Freedom app from Play Store or App Store. Also, do not forget to hit the like button, subscribe to the channel and do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise and break free.